All right, so I left on vacation to Boston here last week with the markets kind of on the precipice of just staying pullback versus starting a correction. We had talked about the expectation that we would eventually be in correction like the Russell 2000, which is probably in bear market mode right now. We talked about that quite a bit in my technical analysis class today for our market scholars. Very big signals that we're seeing in especially the small cap index. By the time I get back, we are pretty much now in correction mode and just starting. A lot of people, I mean, there's been a lot of chatter today about, hey, we're kind of washing out. We're down 10%. It's not necessarily how corrections work. Doesn't mean that we won't go up. And I talk about what my expectations are for the next week or two and why. But also I talk about the expectations for this correction and how long it might last and where it ultimately may end up by the time we get done. So we'll break down what's driving a lot of this price action. Big changes this week versus, and pretty much last week too, versus before in terms of what the risk aversion trade looks like. So we'll break that down as well, why that matters. And then our trade idea of the day is a stock that's breaking down out of its sideways range. And we'll talk about how to trade it. So let's go ahead and get started. Today is Friday, October the 27th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern Time, Monday, Wednesday, and Friday. Come down to the bottom, click this heart. It opens up this tab here. Click that like button. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out. That's how these algorithms work. The more activity they have, the more they'll post them in people's feeds, especially the people who follow us and the people who follow you for that matter as well. So that's a big deal for us. That's why we always ask. Thank you again. Our goal is to get to 100. We're in the 70s a lot lately, so let's see if we can push that up here over the weekend. Thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. As you can see, we got our second consecutive oversold cluster on the market forecast. All three lines down there. For that matter, all three lines, not just below the 20th percentile, which is actually what produces the cluster, but all three of them are below the 10th percentile. The market sentiment line is still falling. It's not in the low reversal zone yet, but it is in bearish territory. Again, another indication of correction here. We are 4% below the 30-day moving average. That is actually a low level. It's in the 3.5 percentile of the past year. But when you look at that comparison to the past 2 years, it's actually not very low at all. Like during the June lows, and then eventually, we were down 8%, almost 9% below the 30-day moving average. We were 9% there, and then over here you're at 8.25% below the 30-day moving average, and then you got at this point here in October, you were at one point down almost 11%, and then again 10.5% below the 30-day moving average. So you can see this is hard. We're getting multiple clusters, and we've seen this before. But before, we were a lot lower. Over here, you just got one cluster, and you were about as low. You're actually lower there than you were now. So, we are hardly in a dramatic sell-off. In fact, when you look at the weekly version, we just barely got a bull tag, right? So if you're looking at this, similar to the last correction we had, it's like January 2022. Now, keep this in mind about the next week or two. Is when you get these bull tags, you see it almost every single time. You get 1 or maybe 2 weeks where you come back up to the moving average. So we are almost 5% below the moving average, 30-week moving average. Expect, a week or two, this next week or two, that will probably rally. It'll be volatile. There'll be some lower shadows, some upper shadows. So we're not going to it's going to be relatively volatile, but don't be surprised if we don't make a run back up towards that 30-day moving average within the next week or two. I would not be surprised at all. The short-term sentiment is extremely bearish on the weekly basis. It's down here. Both lines are below the 5th percentile. That's extremely low for a weekly chart. You can see this doesn't happen very often. Last time we had that was back here at the end of September. We did have a few weeks here in April where we really, I mean, that kind of started the weakness when it got this bearish. Kind of very similar to now. The intermediate line has crossed below the market sentiment line. I mean, we're full-on bearish mode here. The Russell 2000, which is on its 14th cluster over this course of this intermediate decline, actually has its second consecutive weekly oversold cluster. That kind of goes to show just how bearish that is, with the intermediate line crossing back below market sentiment for the first time since back here at the end of last year. When we hit those October lows was the last time we had a crossover below. So we didn't get a crossover below in the end of last year in December or in March. This time we did. So very significant there. We're also, if you notice, we are 10% below the 30-week moving average, which is more dramatic than we have seen before. So we are definitely in bearish mode here. I mean, the last time we had a couple clusters in a row on the weekly chart was again in April of last year, and we still were bearish all the way to the June lows, even with a week or two of positive moves mixed in there. So I mean, we're pretty things are pretty bearish. Here's those 14 clusters that you've seen. Again, this is 14th today. That's again in 20 years, even including the bear market of 2008, 2009. We had a 9 cluster streak at the end of 08. We had a 10 cluster streak at the beginning of 09. At the very end of that bear market, kind of separated. We had 14 clusters on one intermediate decline at the end of 2018, and now we're getting 14 in a row here. So in other words, it's pretty darn rare to be that bearish. We are well below the March lows where we had the financial crisis, the region banking crisis there. I guess would be a better way of saying that. So I mean, that's pretty, we are in correction mode, full-on correction mode, not because we're down 10%. Remember, corrections take months to come back to new highs. Pullbacks only take weeks. So there's a very important distinction there between whether we're in a pullback, whether in a correction. It's not just, are we down 5%, are we down 10%, are we down 20%? That's, that doesn't mean anything. It's a matter of, there's other technical factors that I've been kind of showing you over the last few weeks on these market forecast videos, suggesting that we've been expecting the correction, and we're just kind of getting started here on the S&P for quite some time. Looking at this other weekly chart, here's one of the other big indications. Again, remember how I said it looks very similar to July or last January? Well, here it is again. We are just now breaking below the 40-week exponential moving average on the Heikin-Ashi close, just like we did last January. So the PPO is still positive. It hasn't turned negative yet, but again, that happened back in April of last year. But that's how close. We're less than 1% away from a death cross. We're going to be really close. In fact, I wouldn't be surprised if we didn't have a death cross, or really darn close to it, close to zero next week once we opened up. You can see a pretty sizable candle for a first candle too. It's one thing to get a big candle like this when you've already been bearish for a while, for a few weeks. But we just had a couple transitions, and this is kind of a first one to the downside after a transition. Obviously, we didn't transition back up. In this case, we just transitioned from being bearish to being bearish again. But the Russell 2000, of course, we had already been below the 40-week. We already have a death cross, and we are getting size. And even that size candle is still not dramatically large compared to, as you can see over to the left, some of the other sized candles during actual corrections of 2022. Obviously, we have 3 red arrows here across the board, right? We had 3 greens to a couple days in the S&P, 1 day on the diamonds, a few days, 5 out of 6 on the Qs, but three reds now across the board, full on intermediate mode at the very least, if not, like I said, correction mode, which is where the market sentiment gets down into that bearish levels. Looking at the 2-line versions of these charts, you can see the S&P is finally clearly below the 200-day moving average. Another indication that we're just starting the correction. Corrections fall below the 200-week, the 200-day, and make their way to the 200-week. So that kind of gives you an idea of how much further we can go, or even below that. I've always said that these March lows, these Fibonacci areas here, is the most likely level of how far. Again, it won't go there in every week. As you can see, during 2022, not every week's a down week during a correction. We have plenty of up weeks here. And like I said, I expect next week or two to be up weeks. So there's going to be some ups and downs as we make our way down towards potentially that 3,800 level. Of course, the Russell 2000 is well below the 200 week. In fact, if you look at how far below the 200 week the Russell is, it is more than 10% below the 200 week moving average. That is 12%, 12.5% below. That is clear. I mean, we didn't get that far below on this previous attempts. That is clear. Like, it doesn't get this far outside of the COVID anomaly. It doesn't get this far below the 200 week moving average unless we are in bear market. So as I said before, I believe the Russell 2000 already is in its own bear market as the rest of the markets find their way towards the same thing as well. It's really those Magnificent Seven that's been kind of keeping us afloat. As you notice, the NASDAQ 100 is still almost 11% above its 200-week moving average and just barely broke the 30-week moving average this week. So it's just barely started. Remember, the S&P is below its 50-week, and the S&P, as you can see, is actually a lot closer. It's only less than 5%. So those NASDAQ 100 and those Qs are pretty much nearly 50% made up of the top 7 companies. Then you add on like Broadcom and Netflix and Adobe, still in that technology space. And now you're looking at about 50% of the Qs are its top 10 or 10 of its top companies, all in the XLK, XLY, XLC space, all in that same space. So they're finally as you saw this week, they're finally starting to turn around, and you're seeing the implications of that as the markets are finally starting to show some signs of full-on correction. I mean, look at that. The negative indicator on the S&P, which is another reason why there's a good chance we bounce up in the next week or two. The negative indicator on the DMI is below 10. I mean, that's rare. I mean, we haven't, to go back to the correction here of last year, we never got that during the correction. We never got below 10. And we have now this go around. So that kind of goes to show, of course, the Russell 2000 is a different story. The Russell 2000 here is not below 10. It got below 10 earlier. We've been kind of diverging here. But look at the ADX, how high it is. SPY's ADX is just now crossing 30. Like, it's just really been taking off this week as those Qs have those names in the Qs are finally showing some weakness. Back below 30 on the RSI, again, another indication why we might rally in the next week or two. We're below 30, which is rare. We got a divergence showing up on the CCI. The weekly CCI is still well below 100, so it has to clear 0 before we start even thinking about a bounce coming up here. And then you look at like the the Ichimoku cloud, and you can see we're back. We had an intermediate trend strength going. We're back to an intermediate trend strength again. IWM has been mature and is very, very mature. I mean, that's a huge number. And again, it's probably more bearish. The Russell 2000 now, it is more bearish now on the trend quality than it ever was in any level. Like, the worst it got was over here in May, and we are about at that same level now. So very, very strong, very mature bearish trend. Obviously breaking out of the bands this week, multiple times breaking out of the bands. The bands themselves breaking out of the Keltner channels, and we are last 2 days well outside the lower Keltner channel. So things are definitely bearish in this regard. You would lower high, lower low, closing below yesterday's low, closing below for the week, well below last week. I told you before that we were most likely to get a new 4-week low point than a new 4-week high point. We've gotten a new low point every day this week except for one. 4 out of the 5 days we got new 4-week lows this week. The range is starting to pick up the pace. It's still not very high. Again, to kind of give you an idea of how big it gets during corrections, it gets up above the 10% mark or higher. We're just at 6% now. So again, kind of goes to show how much more downside, how much more these bands have, like the Bollinger Bandwidth, which is a measure of volatility, like how much more it can expand. If I kind of give you an idea of how big the bandwidth gets during a correction, like that's how big it gets, like way up here. So the bandwidth, we're looking like in these areas up here around 15 for correction mode. And as you can see, we're about halfway there. So a lot more volatility, especially with the VIX where it's at. The VIX is barely above 20. It's not even close to 100% versus VIX 3M, the 90-day mark. The VVIX is only at 102. So we haven't had the volatility mode. In fact, we will probably get that volatility washout at the end. Usually you kind of get a good volatility move to begin corrections. This one, like the fourth quarter 2018, will probably be, we'll end it with the big volatility move up around 115, 100, but it probably won't. Like, we have definitely changed the trajectory of volatility. It had been bearish for most of this year, as you can see here. It has been bearish for most of this year, but the 30-day is crossed. You're almost about to get the 50-day cross. When you get those longer-term averages crossing, then you start a new regime of higher volatility that lasts, in this case, months. But in other cases, when we've had, normal corrections like fourth quarter 2018, COVID obviously was a different animal, but still you were above it for months there. But you look at like the fourth quarter 2018, once those crossed, you were above it for months. If you look at 15 and 16, same thing. You were above it for months once those crossed up there. And then 2011, you'll see the same thing. I'm going to go out to 2011 over here. Volatility gets above that, that mark, and it stays up there for months, right? So that's kind of what we're seeing. What I'm seeing here is we're getting above there. There's again, nothing's 100%. But there's a pretty good chance that we're going to continue to trend higher in volatility for a while. And like I said, at least on this initial correction, you'll get that big move up to the 30s or beyond, but most likely into the low 30s, where the VIX itself gets up to this 105, 15% mark. The VVIX gets up to 115, 120. That's probably going to end during the washout phase of this correction at the low points. Rather than kind of a lot of times it happens early and then we retest those lows or go a little bit further. This one looks like it's going to be at the lows. Whenever that will be, it probably won't be until closer to the end of the year, more so than like say in the next week or two, most likely volatility will probably come back below 20 as the markets bounce back up towards that 30-week moving average. Now let's take a look at what's driving this action. You can see over the last 3 months, and it technically has been officially 3 months. If you look at the rate of change here, since our highest close on July 31st, it has been officially 63 days now, 63 trading sessions. That's the 3-month period. And you can see we have fallen more than 10%. Again, another sign, because you don't fall 10% over 3 months during pullbacks. You tend to bounce. I mean, you might fall 10%. Like over here in 2018, we fell 10% from the high. But by the time we got the 3-month period, we either bounced back up or we were down here. We only fell about 6% from the 3-month period. So usually we're bouncing back up. But corrections, we end up keeping going. You can see you hit that 10% mark. You end up after a failed pullback bounce, you go down to lower lows. You go down to lower lows. You go down eventually to lower lows. And so I think, again, after what probably will be a short move to the upside, you're more than likely going to go back down to lower lows because we have hit that 10%. I mean, again, a pullback can be 10% like it was in first quarter 2018, but it has to bounce back up. And obviously it's been 3 months without bouncing back up. And we finally hit that. So that's an important mark that we've hit. And you can see over that 3-month period, the dollar's been the most bullish asset class. The gold has been up there, and it's really been on a tear lately. Even with Bitcoin doing very well in the past week, thanks to that ETF approval. Commodities also doing well. They have up 2% over the last 3 months. Bonds have been down 17%. Real estate down 18%. Small cap stocks down right around there 17.5%. The Q's only down 8.5%, but they're really coming back down over the last couple of weeks. They started, those Magnificent Seven were holding up pretty well. Now they're not holding up as well. Over the past 2 weeks, you've seen here, let's just go back to the past 2 weeks. You've seen that they've really started to show some weakness. Right now, the Qs are down the most over the last 2 weeks instead of IWM. So that's why I say that ratio here of the Qs IWM, which has been so bullish on a weekly chart, is finally starting to show some weakness. And you see on the daily chart here, you can definitely see that weakness as we are breaking down here from these highs around 215. The RSI is breaking down, the CCI is breaking down, all in convergence mode, ready for a move lower as the correlation moves back higher to where it normally is. And you can see the breadth continues to be very bad. The new highs and new lows again back towards the negative 1,000 level. The number of stocks below the 50-day moving average is below 60. I mean, very, very low levels. In fact, the 20-day average is about to drop below 100. And this is all with the skew still actually above 130. I mean, the skew at this time last January, the skew actually broke 130. So the fact that we're still above 130, it goes to show again that people still aren't concerned about are still concerned about the big move to the downside. Eventually, you have a big move to the downside, then that concern for fat tail risk goes down. So the skew goes down. You don't really worry about a big move to the downside once you've already had one. So considering so right now the options market is saying this is not a big move to the downside because they're still pricing in one with how high the skew is. At least they're still pricing in the protection for one with how high it is there. So significant moves, of course. The dollar is one of the bigger reasons why things have been so bullish. Bearish, excuse me. You can see the run it's had after getting that bear tag. It got a bull tag here and bounced. You get the same thing with the TNX, another big reason for a lot of the weakness, making its way up to 5% this go around. Got after multiple bull tags that bounced right back up. We talked about commodities. Commodities had been bullish up until that cluster, and then now they're bearish, right? And that kind of goes to show to me that while this typically should be really bullish for equities, and it hasn't been. It's up today, but it hasn't been. Dark pink shading in a red line. If this starts to fall with equities and bonds start to rise as a result of those correlations getting back to normal, then you're going to see falling yields, which has long been the narrative for the bull case. Actually, what might end up being the bear narrative. Which is generally the case. When yields fall across the board, stocks are not bullish. It's generally pretty bearish when yields are falling across the board. They're not falling across the board yet, but at some point in time they will. But until then, right now, the fact that it is so high and the fact that the yield spread has made its run up here to almost zero on the 210s, about close to the 50 basis point mark. On the 10-3 month. I mean, that kind of gives you an idea that the 10-year, and I know there's some chatter on TV about the yields still have run to go. That's how much run they have left to go till these spreads get towards zero. And like I said, the 10-2 year almost there. The closer these spreads get to zero, the kind of natural peak the 10-year will have right around that 5+% mark, and then that's. Again, once they all start to fall, especially once the 3 month starts to fall, then that's when we're going to actually be more concerned for risk appetite, not necessarily fueling risk appetite. Let's take a look now at the sector moves. And again, over the past 3 months, you can see utilities and real estate have just been horrible. But that's what been over the last 3 months. If you go again to the last 2 weeks here, as things have been going back to normal, this is very normal. And you can see XLY, XLC down there. XLK has been down there as we head into an important week for Apple earnings next week. Like, this is more like we are now back to normalcy here. And if that's the case, then that's a concern, because this is full on risk off mode. We've seen over the past 2 weeks, and then now if you just look at what it was this week, this is this week, right? Utilities are actually up this week. Again, even though yields are not down dramatically, utilities are actually doing well and way outpacing a lot of these other sectors, including energy. You can see down there at the bottom, along with healthcare and communication services. Communication services, of course, getting hit hard by some of the earnings and the big names. XLY doing very well today thanks to Amazon. The one thing about Amazon's earnings, I tweeted this out, but keep this in mind that there's a high probability Amazon fills in this gap. And if it does and gets into this gap and breaks that 200-day moving average, it's going to be a pretty easy fall down towards this 105 level, which will go, that's the source of the strength today, the outperformance in the NASDAQ. And if we lose that and this ratio starts to go back down because of that, then again, that's going to be a source of weakness for the markets, not strength. All right, now let's take a look at our trade idea of the day. I want to take a look at ADSK. As you can see, ADSK really breaking down this past week, going into expiration, okay, still in the range, but by the end of this week, breaking below its range, breaking below the point of control. MACD and stochastics are down. When you look at the market forecast, you see that it's got a bearish forecast now this week, dark pink shading and a red line. In fact, it almost got a cluster. The intermediate line, the momentum line, and the near-term line sitting right around the 20th percentile there, 5.5%. Again, the intermediate line below market sentiment and the reversal zone. So obviously 3 red arrows, and you can see some of the other indicators here that are showing some bearishness. You look at the DMI above 30, well below 20 on the negative, on the positive indicator down there at the bottom. Looking at the RSI and the CCI, they're both at bearish levels, below 40 in the RSI, well below 0, easily below minus 100. In fact, if you look at the weekly, it's just now breaking below the minus 100 level. So an opportunity here for a new correction to be starting on ADSK. You also see that too in these weekly charts. If I look at this other weekly chart here, you can see it's got a breakdown and a golden death cross, and then you look at the market forecast with weekly chart, and you notice that it's got, the weekly chart, it's got dark pink shading and a red line for the first week, and we're down way more than 2.5%, down more than 4.5% below the 30-week moving average. So pretty clear indications. We broke below the Bollinger Band this week, barely, but we did. Right there yesterday, broken below the Bollinger Band. Like I said, breaking below the value area, flirting with the with the Keltner channels. The bands themselves are that close away from crossing out of the Keltner channels themselves. So it looks like we're kind of really getting going on a bearish move to the downside. So what I decided to do here was to do a bear put spread. Instead of buying at the money like we typically do, I went one strike away and then sold the 185. That's easily in range for the, see, this is still 1 standard deviation, right? Let me just check and make sure. Yeah, 1 standard deviation. So by December, you're looking at 170. And so getting down to 185 is like a no-brainer. So pretty high probability trade from that perspective. That's how much flexibility I have to work with in case it doesn't go down right away. And it just has to go down that much, and then time decay will take over from there. So I like that setup, and then we just push that trade through for half my normal risk, and then getting it almost double the reward for the risk that we're taking. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at marketscholars.com for free, follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.